you have definition. You have the definition for, yeah, you have definition, right, by American Institute of Certified Public Accountants. That is slightly modified and given by ICAI, as AICPA is for America, ICAI is for India. Okay, the ICAI was set up in India by the special statute of the Government of India in the Parliament. Okay, so therefore it's a statutory institute. And these are the objectives. There are four objectives of preparing financial accounting. Number one, for providing information. Number two, for systematic record. And number three, for making financial results. And number four, making the financial position of the company. Okay, so this is the objective with which the accounting records are prepared. And the functions are this: we have done it already: measurements, forecasting, decision making, comparison and evaluation, control, government regulation, and taxation. So these are the purpose which the accounting serve. And there are three broad classes of types of accounts, and that is now made into only two. So first one is financial accounting, second one is cost accounting, third one is management accounting. And we have also seen the difference between management accounting and financial accounting. The basic difference is financial accounting information is for the general public, including you and me as students. We have right to access to the information of any company, and it should be publicly available, whereas the management accounting information need not be public. For example, one of my PhD students, is the student and also the vice chancellor of the Islamic Azad University, Tehran. And we put together, went to Care Hospital to get the data. What is that? The how the hospital is doing their costing procedures. So he was doing activity based costing, and the hospital administrator referred us to the accounts department, management accounting department. They have squarely rejected our request. What is that? Management accounting information cannot be shared. If you want financial accounting information, you can get it on our website. It is there in zip folders. You can download it. But management accounting is not to be shared. We cannot share it because that is only for management, not to be publicly available. Okay, right. So this is what we have done. Now let's go to the next one. The next is, yeah. So important terms, and we were doing important terms, right? So what's a transaction? Okay, a transaction we have seen, it's an event, okay, or a business activity for the exchange of goods or services for a consideration, okay, for between two parties, right? That is transaction. Then you have goods and services. What are these goods? Goods are tangible, okay, in nature, and they are a commodity in which a business deals with. And what is good for me may not be good for others, okay, and that may be asset for others. A furniture shop has so many tables and chairs which are goods for them, but for an office like ours, it is furniture, it's an asset, right? So the definition of goods and services, they change. Next is profit. What is profit? Excess of revenue over the expenses is profit. And loss is excess of income over expenses is profit. Excess of expenses over income is loss. And asset, asset is owned by the company. This is different from expense. What's the difference from expense and an asset? Both are spending only, but what's the difference between an expense and an asset? you're spending for asset also, okay, and you're spending for other purchase of material. So that is a current asset. This is an asset. So there are some assets, we will continue in the next lines, next paragraphs. So there are some assets which are staying in the company for a longer time. And you may ask me, sir, longer time, how do you define longer time? I said beyond 12 months is longer time. Beyond 12 months is longer time. Okay, beyond 12 months is longer time. Right. And this stays for several years. That's an asset, fixed asset. And similarly, you have current assets. These are also assets, materials you buy. That's an asset. These assets will be, brought into the company, processed, transformed, and sold to the market, sold in the market to the customers. Okay, so these are current assets. Current assets durability, okay, they stay in the companies not beyond 12 months. Therefore, they are current assets. These current assets also can be called as liquid assets. And why they are called liquid assets? They are converted into cash within 12 months. Whereas when you see the assets, long-term assets, non-current assets, fixed assets, they are there for 10 years, 15 years, 20 years. They are non-current assets. Okay. So primarily for the purpose of trade, if you're keeping, they are called current assets. All the goods are current assets. All the assets, non-current assets. Now, for doing business, you will be bringing in money into the company. And that money is called as capital. That's a financial resource to start the business and to run the business, right? And this money may be from your pocket or maybe from financial institutions borrowed money. So the financial resources that are used in the company are called capital. And this capital, if you're spending from your own pocket, that's called capital. And if you're, borrowing from financial institution or from the general public in the form of debentures, that's called debt. That's called debt, right? Now the liability, okay, the liability. This is on the left side. Liability is both capital and debt put together is a liability. Okay. Then you may say, sir, how your own money is debt? How your own money can be a debt? Now look at this. In business, there is one concept called separate entity concept. What is that? The separate entity concept says the business is separate from its owner. The business is separate from its owner. That means when the owner is supplying capital, okay, to the business, his business is separate from himself, right? So therefore, it is dropped under the list of liabilities. Okay, liabilities we will divide into two. If the liability is there in the company for more than 12 months, beyond 12 months, beyond 1 year, that's liability, long-term liability, long-term liability. But if that liability is less than 12 months, that's called current liability, current liability. Now, if your obligation is beyond 12 months, that's a long-term liability. Obligation of what? To pay. Okay, obligation to pay the principal along with interest. If your obligation is for less than 12 months, then it is current liability. A current obligation is a current liability. A long-term obligation is a long-term liability. Okay, so right, yeah, capital is the owner's money, right? What you pay from your pocket, what you supply, not paying. Paying means you are owing to somebody and you are repaying back. Okay, you're obligated to pay, you're paying, but this is not paying but supplying. The owners supply capital and on which they expect some compensation for the supply of the capital. In business, that compensation is called as a required rate of return, a required rate of return. Probably this required rate of return you will learn when you go to MBA program. But now we will understand it as interest on capital, interest on capital. Okay. To this extent, it is okay for you. A capital needs to be compensated through a reward called interest, right? Now, as you supply capital into the business, whenever you are in need of money, you may take away from business. You know, when business needs, you may provide building, okay, your own building for business. That is also capital. If the same building is bought from outside market, it may cost 1.5 crores. That worth building you're supplying. So that means your capital is 1.5 crores. Okay, and you may supply cash, whatever is the form, maybe in cash, maybe in kind, whatever is the form, when you're supplying, okay, that's capital. You're supplying from your own money. Now, just as you supply, sometimes if it is your own business, let us say yours is marine products business. You deal with the prawns, fish, crabs, okay, all these seafoods. You are into seafood business, okay, and you export. Sometimes when there's a function, okay, when there's a function that you got admission into St. Mary's College and you want to give a treat, okay, your dad wants to give a treat to all his family members, or you got into MBA and you want to give treat, what they'll do, they'll pick up from the business, okay, how much quantity is needed, 100 kilograms of prawns, 100 kilograms of crabs or things like that. I don't know what are the items. You will take 100 like that. 500 kilograms you have taken from your stock of fish, and that is used for your personal work, personal needs for a function. What is that? You're drawing, taking out from business. When you're drawing from business, you cannot say, it's my own business now, chalega. If you're saying that, you're doing injustice to your business, right? I see some of my students, and not some of, most of my students are true businessmen. You know, all these jewelers in the city, Musadilal, okay, Krishna Jewelers, then and you know, all these jeweler stores. I don't remember the list in Somajigud area. Most of them are my students. When I go, they will not do injustice to their business, right? At the most, they can offer me a cup of tea, but when it comes to business, whatever discount is applicable, okay, that discount only they will give me, right? They will give me. And I appreciate that. I appreciate that because they are thorough businessmen. Okay, so because they consider their business is separate from themselves, right? From their pocket, from their own purse, they will spend any amount, but they cannot, you know, they cannot take out anything from the stock. Let's say a pearl necklace is about maybe 10,000. They will not give me, you know, if it's cost, they have acquired it for 5,000. They will not give me at any cost for less than 5,000. If discount is for outside 10%, that is 1,000, they may give me 20% discount, but still there's a profit left over. There's a profit left over. They maintain that. If they don't maintain, that is injustice to the business. Okay, so when, for example, one fellow is very much emotional and he wants to gift. When he gifts, he has to treat it as separate, okay? And if it is separate, you know, he is separate from its business, from his business. What he has to do is he will account for that which is taking out as drawings. Okay, look at the sentence. Will you, anybody will you please read it? Aditya, can you please read it? Drawings, it represents. Go ahead, Aditya.
Yes, sir.
Go ahead, read it.
Drawing, sir.
Hmm.
It represents an amount of cash, goods, or any other assets which the owner withdraws from business for his or her personal use. Example, if the life insurance premium of proprietor or a partner of business is paid from the business cash, it is called drawings. Drawings will result in reduction in the owner's capital. The concept of drawing is not applicable to the corporate bodies like limited companies.
Okay. Uh, right. Let's go to the net worth. I think the examples that I've given are more exhaustive than this. Okay. Next. Uh, next, I want Maria. Okay, Maria already. Likita. Likita.
Yes, sir.
Likita will read net worth.
Net worth. It represents excess of total assets over total liabilities of the business. Technically, this amount is available to be distributed to owners in the event of closure of the business after payment of all the liabilities.
Okay,
This
Ma.
is why.
Stop there. Stop there. Can you see my four fingers here? Four fingers here.
Yeah, sir.
Okay. What is left side for you? This is left side.
Yeah, sir.
This is left side for you.
Yeah.
No, sir.
This is right side. What is
No,
this?
that is,
This is left for you.
That is
your left is right for us, and your right is left for us.
No, this is what is this for you?
Right.
sir.
Right.
right, sir.
Okay. Okay. So look at this one. Equity capital. Okay. Loans, creditors. Okay. And outstanding expenses. These are four types of liabilities: capital, borrowed money, and creditors and outstanding expenses. These are four types of liabilities. Four types of liabilities. Okay. And similarly, you have assets. With these financial resources, you will acquire the assets. What? Land and building, plant and machinery, okay, and debtors, okay, and cash. There's some cash left over also, right? Okay. Now, the total of liabilities should be equal with total of assets. Total of liabilities should be equal with total of assets. Okay. Now, in liabilities, you also have debt component, right? Debt component.
Yes, sir.
So total liabilities is equal to total assets, na?
Yes, sir.
That means if you remove the debt only from your list of liabilities, you will get net worth. Or if you take the total of assets, total assets, and deduct the debt capital, borrowed money, then you get net worth. That is what the wording here. It represents the excess of total assets over total liabilities of the business. Technically, this amount is available to be distributed to owners in the event of closure. If anything goes wrong and the company is to be closed, what is the net worth? What is the net worth? First, debt holders will be paid. The leftover amount belongs to the shareholders. That is the net worth. That is the net worth. And do you know what is the net worth of Mukesh Ambani?
5 crores.
90
crores, sir. 90 crores.
90 crores? Yeah, you can Google it and tell me as I'm going to the next point. Please Google it and tell me the net worth of Mukesh Ambani, the net worth of, what's his name? Berkshire Hathaway. What's his name? What's his name? Oh, okay. Bill Gates. Bill Gates, net worth of Bill Gates and net worth of Mukesh Ambani. Please check it and tell me. Right.
7,600 crores, sir.
How much?
7,600 crores.
7,600 crores is the net worth of
Mukesh Ambani.
Mukesh Ambani.
And the 7,000, how much was 7,000?
600 crores, sir.
76 is the net worth of Mukesh Ambani. Means all this money belongs to him only. Sir,
Yes, sir.
Reliance company, just now you said his business is separate from owner, no? Yes, I
Yes,
stick
sir.
to my word. I stick to my word. This is the worth of the shares that he is holding in the company. This is the total worth of money which exclusively belongs to him, which is less than 5%. It is less than 5%. Okay, 95% of the capital belong to you, me, and the people around us who are buying the shares of this Reliance Industries. Okay, now if this is 9%, what could be, I'm sorry, if this is 5%, what could be 100%? 76 is 5%. If 7,600 is 5%, what could be the 100%? Please calculate and tell me quickly. If 76 is 5%, what is 100%? And do it. Meanwhile, I'm going to debtor. Debtor. You know, most of the goods sold are for credit. When you're selling from as a company, as a distributor, you sell goods on credit. You know, cash sale is only in retail sales. You know, when you need some let's say some groceries, you go and pay either through cash or card. That is, even if you're paying by card, that is your money, right? And you have to pay interest for that money which is supplied by that banker. The banker supplies you money, and that interest you have to pay it later, right? Along with principal, right? So that's your own money, whether it is card or cash, that's your money. And there's no credit concept in retail selling, okay? But in wholesale and distribution, there is huge amounts of business is carried on by on credit mode, on credit format. 85% of the business runs only on credit. Only 15% runs on cash, right? So who are these debtors to whom we have supplied goods on credit? These are debtors. Let us say we have sold goods worth 15 lakhs. When we sold goods worth 15 lakhs, and out of which 10 lakhs is on credit, okay, 10 lakhs worth good, 10 lakhs are locked up in the form of goods with those people, with those customers, okay, credit customers, right? Your 10 lakhs is locked up with them in the form of goods. Therefore, your money is with them. Therefore, it's an asset. I'm telling you one, you know, one rule of thumb. If your money is with others, that's an asset for you. If others' money is with you, that's a liability. Please note, you don't get this in books, okay? This is a simple logic. If your money is with others, that's an asset. If others' money is with you, that's a liability. Okay, so which one do you like? You want your purse to be loaded, or you want your, you know, you want to depend on others? You know, if others' money is in your purse, that's a liability. Okay, if your money is in others' purse, that's a asset. What do you like? You want it to be an asset or a liability? In both, asset. So prefer that let your money be with others and don't just take others' money. And it's a liability. Even if it is friendship, you have to pay. Get a feeling, keep a feeling that you had to pay. All right. So that you are debt free as well as guilt free. Okay. So yeah, please, alarm me when the time is up. The time is up.
Time is up,
Yes,
sir.
sir.
Yes, sir.
Time is up, sir.
Yeah, please stop me. Okay. Okay, then we'll see the next class.
Yes, sir.
Right. Thank you so much. Good day.